Nasdaq 100 just changed its rule. Did you guys know that? Without most of us even noticing, the rules of the Nasdaq 100 have changed. And that change could affect where the ETF money leaving our bank accounts every month actually goes. Most articles describe this as simply a volatility warning, but the real point is different. By the end of this video, you will understand what the Nasdaq 100 actually is, why people invest in this index every month, and how the fast entry rule, which took effect on May 1st, 2026, could affect our ETF account. Let's start. First, what is Nasdaq 100? Nasdaq is the name of the exchange. More than 3,000 companies are listed on Nasdaq, and the broader index that reflects those companies is the Nasdaq Composite Index. The Nasdaq 100 is different. It is made up of 100 large non-financial companies listed on Nasdaq. Major US tech companies such as Apple, Microsoft, Nvidia, Tesla, Google, Meta, Broadcom are all included. So when people say, I invest in Nasdaq ETF every month, that means they are actually talking about a Nasdaq 100 ETF. Both QQQ and QQQM track the Nasdaq 100. There are ETFs that track the entire Nasdaq composite, like Fidelity 1Q, but the market standard is overwhelmingly QQQ, which tracks the Nasdaq 100. However, starting on May 1st, 2026, the inclusion rules for Nasdaq 100 changed. And this is the main point of today's video. Under the new rule, if a newly listed mega cap company on Nasdaq is large enough to rank within the top 40 of existing Nasdaq 100 components by market cap, it can be added to the Nasdaq 100 after just 15 trading days. 15. In the past, newly listed companies had to trade in the market for a longer period of time before being added. This gave the market time to adjust and allowed prices to stabilize, which makes sense. This was known as the seasoning period. In simple terms, it was market adjustment period. But now for mega cap IPO companies, their waiting time has been significantly reduced. On the surface, the reason makes sense. These days, companies stay private for much longer. By the time they finally go public, they're already massive. You probably know the companies SpaceX, OpenAI, and Anthropic. Those are good examples. The logic is that if companies like these big companies go public but enter the index too late, the Nasdaq 100 may not properly reflect the real market. But this is where the problem begins. ETFs are not funds that make their own judgment about which stocks to buy. When a stock enters the index, ETFs have to follow the rules. It does not matter whether the stock is expensive, whether IPO hype is too high, or whether the company is still not fully proven. If it enters the index, the ETF has to buy it. In simple terms, this is forced buying. A hot mega cap company goes public. Right after the listing, investor attention can flood in, and the stock price can rise sharply. Then, a few days later, the market realized that Nasdaq 100 ETFs will have to buy that stock. Professional investors, including hedge funds, can buy first and wait, and then ETFs comes in later because the rules force them to buy. Those early investors can sell at a higher price. So, who may end up buying at the expensive price? It could be ordinary investors like us who invest every month through Nasdaq ETF like QQQ. That is the real issue behind this rule change. This is not just about volatility may increase. The key issue is the passive ETF investors may end up absorbing the high initial prices of mega cap IPO companies. Of course, there is a counter argument. For long-term monthly investors, one or two IPO additions may have only a limited impact on total returns. If you invest every month for 20 years, that is 240 separate investments. A specific IPO inclusion would only affect a smaller portion of that total. But I do not see this as just a one-time event. SpaceX could be added in June 2026 at a valuation of around $1.75 trillion. OpenAI could become eligible in the fourth quarter at around 850 billion. Anthropic could also become eligible sometimes between late 2026 and 2027 at around $380 billion. And after that, more mega cap unicorns like Stripe, Databricks, and XAI may still be waiting in line. Even the S&P 500 is considering a similar fast-track approach. If that happens, VOO and SPY, those ETFs, can also follow the same pattern. If this happens once, you might simply say, okay, this time I just bought a little expensive. But if it happens 4 or 5 times over the next 1 or 2 years, the story changes. This is not just a single event. It could be structural change in how index investing works. So what should we do? The first suggestion, if your portfolio is heavily concentrated in the Nasdaq 100, it may be worth considering some diversification into S&P 500. ETFs like VOO and SPY can help investors who do not want to be overly concentrated in big tech. Second, around Nasdaq 100 rebalancing period, or when a mega cap IPO may enter through the fast entry rule, you could consider delaying your purchase by a week or 2 or splitting your purchase into smaller amount. Third, it may be worth considering a switch from QQQ to iShares S&P 500 Growth ETF, ticker IVW. There are 2 reasons. First, big tech exposure remains very similar. The correlation between QQQ and IVW is around 0.97. The closer number is to 1, the more similarly the 2 ETFs move. A correlation of 0.97 means they move almost the same. Core names like Apple, Nvidia, Microsoft are still included. Second, the S&P 500 Growth Index that IVW tracks is not limited to companies listed on Nasdaq. That means IVW is one step further away from the direct impact of the Nasdaq fast entry rule. The S&P 500 may also consider similar rule changes in the future, but for now, it has not adopted the same rule, and even if it does, it may take a more conservative approach than Nasdaq. In the end, monthly investing is not just about buying automatically. It's about understand who the rules were designed for and deciding how you want to respond. But again, this video is based on my personal opinion and I'm not a financial advisor. Please make sure to do your own research before making any decisions. I'm here to share my insight. If you found today's video helpful or enjoyable, please don't forget to hit the like and subscribe to the channel. Thank you for watching and see you soon.